You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Today, I want to talk about things that happen when you don't pay back your loan, your life insurance loan. And I'm not talking about later on in your life when you're retired or you're just seeking that passive income. I'm not talking about then when we are then making a plan to pull money out of your policy and as passive income and use that for your retirement years. Because at that time, we will put a plan in place where we are not planning to have to pay the money back. We will be taking a mixture of withdrawals and loans to make sure that we can just pull that money and not have to worry about paying back the policy. So the things I'm going to go over in today's podcast are really referring to the years where you are building your banking system, building that pool of cash, your financing tool. During your building years, you for sure want to make sure you are paying yourself back like an honest banker. It's during these years that you will be recycling the money, using it for one thing, paying yourself back, using it again, and making sure that you are at least getting the interest paid and paying yourself back the money so that you can have it there to use again and have it there for your retirement years. But first, before I get into that, I was going to give a refresher on ways to repay your loan and how to set up a loan repayment. So first of all, you don't want to take out loans with no intention of paying them back. You do have 100% flexibility in how you repay your loan, but during your younger working years, it's not great to just not pay anything back. That's not going to be good for you. The idea is to repay yourself plus interest to replenish the funds you borrowed and to keep your banking system growing. The extra interest you pay yourself over and above the cost that the insurance company is charging is one way to help you grow your banking system. The action of borrowing and paying yourself back is allowing you to recycle your money so you can use it over and over again. Let me remind you of some of the methods to consider for repaying your life insurance loan. Now, the most straightforward method would be to make regular payments towards the loan. With the primary companies that I work with, you are able to schedule a monthly loan repayment with an automatic draft, so you can just set it and forget it and not have to worry about it. This is one of the best ways, in my opinion. The reason that I think it's one of the best ways is because if you're paying the company back monthly, then you are reducing the amount of interest that you will be charged on your loan, and therefore paying interest on a shrinking balance throughout the year. Because remember that when you make loan repayments to your policy, 100% of the payment goes to principal. They don't break away a chunk for interest and then apply the difference to the principal. The whole payment goes to principal, so you are lowering that loan balance just as fast and efficiently as you possibly could. So then making regular payments will reduce that loan balance and the interest that accrues over time each month as you hit your next anniversary date. However, you do have these other options as well. You can send loan repayments whenever you want throughout the year, for example, or you can pay interest only, either monthly, once a year when you receive your interest statement, or again, whenever you want. You could be building up the loan repayments first in a separate bank account, and from there you could send payments to the insurance company whenever you want by either mailing a check, if you still have those, because I still do, I still have checks, or you could send loan repayments by using your bank's bill pay, or by having the funds drafted. Again, my preference is to set up an automatic draft each month so that your loan balance is coming down each month and you're saving that interest and paying interest on a shrinking balance. Another option would be pay the loan off all at once. If you were to do that, if you were to come into a large sum of money, such as a bonus, an inheritance, or savings, you may choose to repay the entire loan balance all at once in one lump sum. Good news, there is no penalty for doing that. You can pay it all off in one lump sum. And as soon as you do so, you will restore the policy's full value, full death benefit, and benefits overall. Now, if you have a life insurance policy with a mutual company, your policy will pay dividends since you are now a part owner of the company. So another option you have is to use the dividends to repay the loan. If you request that the dividend be paid towards the loan and it doesn't cover the full balance or the full loan interest due that year, then the company would bill you for the difference, which you could either pay or not pay. And then if you don't pay it, it will add on to the balance of the loan. So this isn't one of the ways that I generally suggest to people, as it's best if the dividends go back into the policy to build your cash value and pay up more insurance. But it is an option. Another option that you would have, if say you were in a huge bind and could see no other way to eliminate this loan, would be to surrender the policy, which of course is a last resort and not something I would suggest at all. We usually can come up with some creative way to help alleviate something, the premiums, or so you can redirect money back to the loans. There's usually a creative way to help you if you get into a bind. But if worst comes to worst and you don't know what to do, I would first suggest to surrender some paid up additions. By surrendering paid up additions, you won't lose your policy, only the paid up additions that your loan is against that you are surrendering. You will basically be paying off your loan from your cash values since these loans are backed by your cash. So this is definitely a second to last resort because you would be diminishing the cash value that you've been trying so hard to build, since every dollar captured will be earning interest and dividends for you until you pass away. So we really want to avoid surrendering paid up additions if we can, and certainly from surrendering the policy because then you lose it all. Now, here are some consequences of not repaying your life insurance loan. Again, I'm talking about those building years and the earlier years, not in your retirement years. Interest on a life insurance loan accrues over time, which means the outstanding balance will grow if it's not repaid or if you're not paying at least the interest. If each year that goes by, you choose not to pay anything towards your life insurance loan, well, your loan will get bigger. If you do not repay the loan at all, the amount you owe, including interest, will be deducted from the death benefit that's paid to your beneficiaries. So in the end, which is part of the planning, actually, once we're retiring, we know that the loans we're taking at that time, that the difference that you owe to the company, that will be taken out of the policy before they pay out your beneficiaries. This means that your beneficiaries will receive a reduced payout, reduced by that loan amount that they had to keep, the company had to keep. However, the death benefit tends to grow very well starting with year one. So even after subtracting any loan outstanding, it's possible to still leave your beneficiaries with a higher death benefit than when you started the policy. Depending on how long you live, it's very, very possible to leave your beneficiaries with a much higher death benefit than what you started with. If you live a really long time and then you're into your 90s and you've used a lot of the cash, well then, yeah, it will be diminished, but at least there should be something there for your final expenses and then hopefully a little more than that. Now, if you're maxing your loan out every chance you get and not paying it back, non-repayment can eventually cause your policy to lapse. If the loan balance plus interest exceeds the policy's cash value, the insurance company could terminate your policy. This is why you don't want to just borrow, max it out every chance you get without replenishing the money or at least paying the interest only. You want to be a good banker. You want to pay yourself back like you would any loan to keep IBC working in the best way possible. You definitely wouldn't want your policy to lapse and leave your family unprotected. If that were to happen, you may have to request a reinstatement, asking your policy, or go through underwriting again for a new policy to make sure that your family stays protected at a future time when your health could have declined and the cost of the death benefit will be higher. Now, if your policy were to lapse, the outstanding loan amount may be considered taxable income by the IRS if the funds that you have used are higher than your cost basis, the funds that you've borrowed. And you definitely don't want an unexpected tax bill. Not cool. In addition, of course, you would lose the other benefits that come with the policy, such as the death benefit, the critical, chronic, and terminal illness rider, or any other rider that's on the policy. So in conclusion, you just want to be sure you pay yourself back. Be an honest banker. You have many repayment options. You have the ultimate flexibility from the best possible place you could ever take a loan. And all the while, your snowball of cash just continues to grow as you borrow and repay yourself, continues to grow with interest and dividends with the mutual company. You will be earning on an uninterrupted growing balance of cash while you pay on a shrinking loan, and you'll come out ahead in earnings. Over time, you should be able to grow your banking system as well. So there truly is nothing I've seen that's more powerful than creating a banking system and being an honest banker. So if you're feeling ready to look into this further and would like my help to build a plan for you and to be your advisor and coach, you can reach out to me. You can reach me at Valerie@alphaomegawealth.com. I look forward to meeting you and helping you get started. Thank you so much for listening. I hope you have a great week.
This is thepodcastfactory.com.